In week 8, we go over stock valuation, and they talk about basically two different methods: a discounted cash flow approach and the adjusted present value in terms of calculations. And then there's comparables and multiples. In the real world, for your interest, pretty much everything is used except for the APV. That's more of a theoretical one, but you need it for your test, so we're going to go over it. I'll do an overview first, and then we'll go through some detailed calculations. The DCF essentially is saying you take the present value of all future cash flows. And that's the way an asset should be valued. And the question then is, what are the future cash flows? So you're looking at the future cash flows for a company. So the way it generally works is you take a forecast. I'm going to put here for 5 years. It could be longer, it could be shorter, but let's suppose you take a 5-year forecast. And then you take the present value, and this I'll write here, cash flow. We're not talking about income, we're talking about cash flow. You take the present value of this cash flow, and then you take a terminal value. What's the business going to be worth at the end of the forecast? So value in year 5. And this often is estimated by some sort of multiple, or you could say it'll grow in perpetuity at 2% a year. So you take an estimate of the value of the business at that time. Or instead of writing in year 5, I'll say at the end. So this will tell you what the business should be worth at that point. And then you take the present value of the terminal value. And once you got these two numbers, you have the value of the business. So if I was to say that this is A and this is B, then A plus B is equal to the value of the enterprise. Okay, so let me write it out in full. So the enterprise value, which I'll just call EV, is equal to the present value of the free cash flow forecast plus present value of the terminal value. And FCF is free cash flow. And the key here, or one of the key differences, is that the present value is done using the weighted average cost of capital as the discount rate. Okay, so that's going to be a difference from the APV and the DCF, which we'll see in a bit. Now, what this gets you is the enterprise value. Remember that enterprise value is equal to debt plus equity. So if we're trying to calculate share price, then what we really want is equity. So we say equity is equal to the enterprise value minus, right here, net debt. So if we take the debt off, we'll get the equity value divided by the number of shares, and that's the price. And net debt is just equal to debt minus cash. Okay, so if you have any extra cash lying around in the books, they take that off to calculate the value of a business. So that is the discounted cash flow approach, which is used most often in real life. APV is similar. It is you take the present value of the cash flows of the free cash flow again. Everything exactly the same way, except one difference is actually let's go through the whole thing. Also take present value of the terminal value, And then the differences between this and the DCF is you also add the present value of tax savings on debt. So if you've taken on some debt, interest is deductible, you get some tax savings. And in this case, the discount rate is the cost of debt. Okay. And these two are essentially different than the DCF approach. Okay, so that is really what makes things different between the two. Other than that, they're very similar approaches.